Every country is broke, or at least, that's how it feels. Debt clocks spin like roulette wheels. Budgets groan under interest payments that swell with each tick up in rates. Politicians promise growth, accountants whisper insolvency. And yet, in this apparent scarcity, someone is still getting rich. Tonight, we follow the money to unmask the lender that profits when nations plead for time. You're watching Hidden Finance, where we pull the curtain on the money behind the headlines. Broke doesn't always mean bankruptcy. It means a future mortgage to the past, a budget captured by yesterday's promises. Across the world, public debts have climbed above $300 trillion, a stack so high it casts a shadow across every ministry of finance in many countries. Interest costs now rival education budgets, or even defense. Governments borrow to refinance old obligations and to smooth new emergencies, creating a treadmill that never stops moving. But they don't borrow from a single bank, they borrow from a system. That system was born in the ashes of World War II. Bretton Woods created a new financial map. The dollar as the anchor, gold as the promise, the IMF and World Bank as the official keepers of order. The United States emerged as the creditor to a shattered world, its factories humming, its balance sheet strong, its currency convertible to gold at $35 an ounce. For a time, the arrangement worked: stable exchange rates, controlled capital flows, disciplined budgets. The world rebuilt on a foundation of fixed rules and a dominant dollar. But beneath the surface, forces were already eroding the bedrock. In the 1960s, a quiet revolution began in London. Soviet dollars, yes, dollars held by the Soviet Union, were placed in British banks. Beyond the reach of US regulations, bankers saw an opportunity. If dollars could be borrowed and lent outside America, they could create dollar credit without ever touching the Federal Reserve. The euro-dollar market was born, an offshore dollar system that grew in the shadows, lubricating trade, speculation, and the growing deficits of the era. Meanwhile, America was spending heavily on Vietnam, on social programs, on growth itself, and the world asked for gold in its place. The math didn't work, the confidence cracked. In 1971, President Nixon closed the gold window. Dollars would no longer be traded for gold. 2 years later, oil prices exploded, and a second revolution unfolded. Petrodollars, the oil profits of OPEC, were deposited into New York and London and recycled as loans to the developing world. The dollar no longer needed gold. It had oil and the global banking system to enforce its reign. Private banks became global bookkeepers, wiring and rewiring money from surplus states to deficit ones, collecting fees and spreads along the way. The hidden lender wasn't the IMF or the World Bank. It was the offshore dollar machine, flexible, fast, and fabulously profitable. Then came the first reckoning. In 1982, Mexico announced it could no longer pay its debts. Volcker's Federal Reserve had pushed interest rates sky-high to tame inflation. Latin America's adjustable loans suddenly had impossible price tags. The IMF arrived with loans conditioned on austerity. Cut spending, devalue, restructure. Banks were made whole or close to it. Populations were told to wait for growth that came late, if at all. The political fallout was deep, but the message was clear. When a country is broke, it's not a single creditor in the room, it's a network, and the network sets the terms. The 1990s were a masterclass in motion and reversal. Mexico's tequila crisis in 1994, then East Asia in 1997, where nations that had saved diligently were undone by hot money that rushed in, then sprinted out. Peg currencies broke, hedge funds feasted, and the IMF wrote new scripts of reform and restraint. The Washington Consensus promised stability, privatization, and openness, but for many, it delivered contraction and social pain. Again, the hidden lender was not the institution issuing press releases. It was the deeper plumbing, the dollar-based system that enabled fast flows, then demanded hard exits. In 1998, a hedge fund called Long-Term Capital Management nearly blew up the system. Using models that tamed risk on paper and magnified it in reality, LTCM's web of trades threatened to pull down multiple banks. The Federal Reserve convened Wall Street in a room not to save a hedge fund's founders, but to save the system from its own feedback loop. It worked barely. A new idea hardened into doctrine. If the offshore dollar system stumbles, the Fed will steady it. The lender of last resort hadn't just become national, it had become global. Then came the 2000s, the great swell before the great fall. China boomed, commodity prices soared. The global savings glut recycled surpluses into Western bonds. European banks, especially, borrowed dollars offshore to buy higher-yield assets, including U.S. mortgage securities, powering an enormous shadow banking engine. Repo markets, short-term loans backed by securities, acted like a money factory, multiplying leverage on collateral that looked safe until it wasn't. Everywhere you looked, there were dollars that weren't in America, promises payable in a currency only one central bank could truly supply. The invisible lender was writing the world's IOS in a single ink. In 2008, the bill arrived. Leverage cracked, Lehman failed, and the global dollar system gasped for air. The Federal Reserve opened dollar swap lines to foreign central banks, allowing them to lend dollars to banks at home. At the peak, roughly $600 billion flowed, with Europe receiving the lion's share. No election authorized it, no global treaty demanded it. It happened because it had to. The hidden lender had shown its face. It wasn't just the IMF, it was the Fed, the dealer banks, and the offshore networks acting together to prevent a dollar shortage from strangling the world. The aftershocks rolled across the Atlantic. In the Eurozone crisis, sovereigns wobbled and banks trembled. Money market funds in the US quietly pulled funding from European banks. Cross-border dollar liquidity dried up. The European Central Bank launched massive long-term refinancing operations, LTROs, and later promised to do whatever it takes. Behind the speeches was the same old story. If the world's accounting is done in dollars, then every European banking scare is also a dollar scare. The hidden lender was now a duet, US dollar lifelines paired with European guarantees. In 2014, oil prices collapsed. The dollar surged, emerging market currencies buckled. Corporations from Brazil to Turkey that had borrowed in dollars found their debts heavier in local terms. A technical term, the cross-currency basis, slipped deeper below zero, a sign that demand for dollars outstripped supply. Hedging dollar obligations became more expensive, refinancing windows narrowed. Banks and traders made money on those frictions, every basis point a toll on necessity. Once again, scarcity for some was income for others. By 2019, cracks appeared in the core. The US repo market, the short-term funding highway, seized up, and the Fed had to intervene to keep overnight rates from spiking. Then the pandemic hit in 2020, and the scramble for dollars became a sprint. The Fed reopened and expanded swap lines, created a new facility to lend against foreign central banks' treasuries, and backstopped markets so heavily that even corporate bond spreads collapsed. Money market funds swelled to the trillions as savers fled to cash-like safety and earned newly rich yields when rates rose. The hidden lender had adapted again, centralizing support while privatizing the profits of transmission. Then came inflation and the fastest global rate hiking cycle in a generation. Yields rose, currencies strained, interest costs exploded. The United Kingdom's pension system lurched in 2022 when leverage met volatility, and the Bank of England had to buy bonds to buy time. In emerging markets, a wave of restructurings, Sri Lanka, Zambia, Ghana, revealed a new cast of creditors at the table. Chinese policy banks, global bondholders, and commodity traders with prepayment deals. Someone was still getting rich, coupon clipping bondholders, carry traders rolling funding, intermediaries taking fees on every turn of the cycle. Crisis is a cost center for governments, but a revenue line for the people who lend to them. Let's mark the turning points. In 1971, money was freed from gold and tied to faith in the dollar. In the late 1980s, the Brady Plan turned old bank loans into tradable bonds, birthing a liquid market in sovereign risk and crowding in new classes of creditors. In 2008, the Fed proved it would lend to the world to save the dollar system, and in 2020 it did so again on a greater scale, even buying corporate bonds by proxy. In 2022, we learned how quickly higher rates can weaponize debt service against fragile budgets. Each turn of the wheel tightened the system's grip and deepened its profits. Who profits start with the obvious, banks and bondholders, but don't stop there. Money market funds, now holding trillions, earn handsomely on safe bills and repo, channeling household savings into the bloodstream of the state. Dealer banks arbitrage tiny discrepancies across currencies and maturities, making a basis here, a spread there. Pennies that become mountains when multiplied by scale. The IMF, the official firefighter, charges surcharges to heavy borrowers, fees that have run into billions, even as it argues those costs enforce discipline. Chinese policy banks lock in oil and mineral collateral for long-dated loans. Commodity traders prepay governments for future shipments, extracting returns above sovereign bonds. And always, lawyers and courts in New York and London enforce the contracts, with vulture funds poised to profit from holdouts and hardball. The consequences are everywhere, and they are not abstractions. A rising share of tax receipts in poor countries goes to interest, money not spent on clinics, teachers, or clean water. In middle-income states, growth by credit becomes stagnation by interest, investment delayed, wages flat, politics brutal. Austerity breeds protest. Protest breeds uncertainty. Uncertainty raises the price of borrowing, closing the trap. In rich countries too, interest now competes with priorities, pensions, healthcare, defense, and forces choices politicians would rather defer. When the bill for the past steals the budget for the future, societies feel older, poorer, and angrier. Today, talk of de-dollarization is louder than ever, and yet the plumbing says otherwise. Central banks diversify reserves, yes, and buy more gold, but trade is still billed in dollars and debts are still priced in dollars. The renminbi makes gains in regional pockets, though capital controls and trust gaps limit its ascent. Sanctions have weaponized finance, pushing some states to build new rails, but those rails still connect to the dollar at the junctions that matter. The dollar's strength isn't just politics. It's lock-in, a network of contracts, habits, and hedges that reinforce themselves. And in that network, the hidden lender remains the default. What should we watch now? Climate finance promises trillions, but who will lend and at what terms? Private credit funds, the Apollos, Blackstones, KKRs, are stepping into spaces once held by banks, writing loans to companies and, increasingly, to state-linked projects, with covenants kept in the shadows. Stablecoins, crypto's dollars, now hold vast hordes of US treasuries, piping dollar liquidity into corners of the world banks avoid, while quietly becoming another arm of dollar demand. Central banks test digital currencies, yet even those experiments settle back into the same old hierarchies. It's not just who lends, it's who sets the rules of rollover when the music stops. So who is the hidden global lender we came to unmask? It's not a single institution, though sometimes it wears the face of one. It is the offshore dollar system, the eurodollar markets, the dealer banks, the money funds, the swap lines, coordinated in crisis by the Federal Reserve, monetized in calm by every intermediary that clips a fee. When nations are broke, this system doesn't panic, it prices. It adjusts terms, widens spreads, imposes conditionality via markets and ministries alike. And in each turn of the cycle, it pays itself first. If this sounds conspiratorial, it isn't, it's contractual. The incentives are out in the open, the architecture is published. The minutes of emergency actions are archived. The mystery lies not in secrecy, but in scale, billions of tiny agreements that add up to one giant fact. The world runs on credit, and its fuel is the dollar. The winners are those who own the pipes, understand the flows, and never have to sell on the worst day. The rest of us live downstream, paying through prices, taxes, and time. There are ways out, or at least, ways to make the trap less tight. Countries can lengthen maturities, issue more in local currency, build buffers in good years, and regulate the leverage that makes small shocks fatal. Multilateral lenders can rethink surcharges and shear losses faster, rather than socializing pain and privatizing profit. Creditors can accept that restructurings must be orderly and quick, because delay compounds pain and raises the ultimate bill. And citizens can demand budgets that invest in growth rather than gamble on the next cycle of cheap money. But realism matters. As long as commodities, shipping, and corporate balance sheets speak in dollars, the system we unmasked will be the super lender, always present, always pricing. Even if another currency rises, its ascent will likely mimic the same pattern: offshore markets, private issuance, a central bank that swears it isn't global until it must be. Finance is power precisely because it is invisible in plain sight, contracts that feel like weather, interest that feels like fate. To change it requires not just will, but architecture. The story we trace tonight isn't hopeless, it's honest. Understanding who gets rich when countries are broke is the first step toward policies that protect people, not just portfolios. The hidden lender is not invincible, it is just organized, disciplined, and protected by the inertia of habit. If we can see the pipes, we can regulate the flow. And if we can price time more fairly, we can grow into the future rather than borrow it. This has been Hidden Finance, where the balance sheet is the plot, and the quiet flows decide the loud headlines. In a world that keeps borrowing from tomorrow, the true lender is invisible, but its bill is always due.